Hello, friends, clients, and colleagues. This is Rich Siegel with ARQ Wealth Advisors, and today is Tuesday, April 26th. Time for another market update. Three areas of focus today. The first being the Fed's policy pivot. Number two would be the bond market, and three would be the stock market. So first and foremost, the Fed, headed up by Jerome Powell, has really pivoted their monetary policy stance in the last month or two. Prior to the last couple of months, the consensus was that the Fed would raise rates 3 or 4 times starting in 2023 to normalize rates when they dropped rates to zero during the pandemic. That's kind of a doomsday situation, and we're no longer in a economic doomsday. However, because inflation is currently at 8.5%, the way to tamp down inflation, the playbook, would be for the Fed to raise rates more aggressively, kind of slow things down a bit in parts of the economy, and that would bring inflation down to a more reasonable level. So at this point, the consensus is that the Fed's going to raise rates 8 or 9 times this year. They've already raised rates once by 0.25%. The next meeting is early May, and by all accounts, we're probably looking at about another 0.5% increase. So because the Fed has telegraphed such aggressive action, the bond market has already moved way up in yield, and when yields go up, bonds prices fall. So all that being said, at this point, bonds have been hit relatively hard. In fact, it's been the hardest in decades. At this point, bonds look much more attractive, and in many cases, they're trading at discounts to par, 90 or 95 cents on the dollar. So bond holders have experienced some short-term pain, but there's some long-term gain potential here. Not only are yields higher and dividends will be paid out in greater numbers, but also you stand to make the money back between the discount back to par. Here's a chart of some of the damage this year in the bond market. You can see the worst of it is in the long end of the Treasury curve here, 20-plus year Treasuries, down 18% this year. Global bonds, the orange, down 11. U.S. aggregate, down 9. This category here is what we call ARQ non-traditional investments. Essentially, these are liquid alternatives, and these were put into client portfolios to kind of hedge out exposure to rising rates. For the year, our clients are down in the 5% range on their bonds. Obviously, not fun to be down at all, but nowhere near the damage of some of these broader benchmarks. Again, we think most of the damage here is done, and now we could hopefully enjoy lower prices and higher yields for a while. As far as stocks go, it's been pretty ugly. When rates go up, bond valuations go down. So when you hear over the long term that the average price to earnings ratio on the S&P 500 is 16 times, that's usually because over the 20 or 30 year period that refers to, the 10-year Treasury is yielding 4 to 5%. So in recent years, valuations have been much higher. In fact, up to just several months ago, the forward price to earnings ratio on the S&P was over 22 times earnings. Tech stocks have been hit the hardest and tend to do the worst when rates go up so aggressively. As of today, from peak to trough, actually the high of the market, it depends, but the S&P and the Dow started in January, and then the NASDAQ hit its high in November of last year. But this is the damage here. The Dow is down 10% from its high, S&P 13.3, and the NASDAQ is down 23%, already in bear market territory. Coincidentally, the average correction, meaning 10% or greater loss in the market, is 14% since 1980. So we're really kind of, dancing around the average, the long-term averages here. Some of the real damage has been done in these kind of high-flying tech stocks, the big winners of the 2020 pandemic year. You can see here the NVIDIA this year is down 36%. Zoom is down 44%. And really in the news a lot recently is Netflix down 65% this year. So it's been pretty ugly, but there are some reasons for optimism. First and foremost, price to earnings ratios today, according to my math, are about 17.7 times for the S&P. Pretty close to averages historically, especially when rates are in the 3% range. Growth is trading at 24 times. That seems expensive. However, growth tends to trade at multiples that are higher than the market. And then value is right around the historical averages. Think of financials, energy, materials, utilities, etc. Those are your value sectors. What's really intriguing is that some parts of the markets are really cheap right now. The cheapest part of the U.S. market is small cap value, trading at 12.5 times earnings. That's by far and away the cheapest part of the U.S. market. And then emerging markets, which for several reasons have been hit hard lately, specifically the strong dollar, 11 times earnings. Very cheap. And then lastly, periods of extreme pessimism are actually, it's counterintuitive, but extreme pessimism is good for stock returns. So you can see here, going back to the 70s, these blue dots here, these inflection points, and then this is extreme pessimism. We're here now. And then the gray line is the S&P return, subsequent return. So you can see here, big return, et cetera, et cetera. And then when there's extreme optimism and complacency, over here above the line, you have lousy returns. So we have cheaper bond prices, higher yields, cheaper valuations on stock. Actually, earnings are coming in now for Q1. They look pretty good. So we think that there's probably more upside potential here than downside. It's an asymmetric risk return. We're excited for the future. But we do think we'll have some more volatility right now. There's a lot going on in the world. So we just need to kind of sit tight. And we think the second half of the year could be very, very good. But for now, things are tumultuous as news comes in. More to come. Thank you for your time and have a wonderful day.